We are live, gentlemen. Just give it a quick minute or two for a couple people to hop on, and then we'll rock and roll. Doug, you seen a lot of apps this week?
Actually, I am seeing a lot of apps this week.
Yeah.
Seeing a lot of contracts this week, too.
Yeah. Well, there was a ton of activity this past weekend. I kind of figured it's almost like overcompensation for people being locked inside their house for so long.
Mm-hmm.
I had one listing from Saturday to Monday, there was 18 showings.
Wow.
Yeah, which is ridiculous. I mean, it's a nice, nice condo, but it's not, it's like we were giving away gold. I think just so many people had been waiting to come down for so long. Once the beaches open and the boardwalk open, and it was like, all right, we're coming down.
Yeah.
We saw an uptick in showings on all listings, except for high end. Some of the high end stuff still isn't seeing much, but everything else seemed to have a lot.
I saw a lot of owner-occupied stuff this week.
Yeah.
Which had been noticeably absent or the volume of it, I should say, for the past couple of weeks.
All right, let me get rocking and rolling here. So again, we're back, Blue Homes Live. Brian Steer, Ben Haberman. We're back with our resident mortgage expert, Doug Miller of Aspire Home Mortgage over in North Wildwood. Just to kind of get an update as to what is going on currently in the mortgage market. So I guess the first question would be, Doug, are we starting to see any kind of turn in the mortgage market, heading back to, pre-COVID world in the mortgages?
It's a great question, Brian. Yeah, we are seeing some positive signs in the credit markets. A big thing that happened last week, a company that we do work with called Angel Oak, they are primarily what's called a non-QM lender. QM stands for qualified mortgage, and that's all your Fannie Mae, Freddie Mac mortgages, the typical stuff people get. What Angel Oak does is they do like the bank statement loans for self-employed borrowers. They do no doc loans for investment properties. They do large loan size jumbos. And immediately after COVID-19 hit, all the lenders that specialized in that type of paper basically stopped writing loans for, I guess we're going on 2 months now. That segment of the market had just completely shut down. And Angel Oak, who's one of the biggest players in that space, went live last week, and that's a good sign, because that means that they can then do those deals and securitize them and sell them off on Wall Street, and that means that it's a sign pointing that things are getting back to normal. Nice.
And now I know I heard a lot, and we talked a lot about even restrictions or things that changed in the qualified market, even with like FHA loans and things like that, with them changing their, not FHA, but banks changing their requirements as far as credit score goes and things like that. Is any of that changing?
Yeah, that is also changing. And I think all that goes hand in hand with what Angel Oak's doing. But right after COVID-19 went down, what took place in the secondary market, and the secondary market is this place where lenders take their loans to sell them and recoup their investment. The secondary market for FHA mortgages for credit scores below 660 disappeared after COVID-19. Almost every lender that was in that space doing loans from like 580 to 660 credit scores, they almost all immediately pulled out. And what we've seen is gradually, and last week in particular, I noticed an investor we used quite a bit. They opened back up to a 620 score. Now, these are not FHA rules. Everyone needs to understand. These are specific rules by individual lenders on what type of loans that they're going to originate. But the softening of the guidelines, the elimination of some other overlays that they're putting on deals, and overlays are again rules that lenders have specifically for loans that they're going to book, and they're starting to roll back the extra requirements, and they're starting to roll back the increased credit scores, especially in the FHA world.
Right. So yeah, you made a good point there. I want to jump back to real quick because I've had this come up in my, throughout my career with deals there where people will get lied to from their lenders. And I just want people out there to understand what you're saying. FHA does not necessarily have a minimum credit score. And I've been in situations with deals where we'll get to a certain point and then the lender will say, oh, FHA changed their regulations and we can't take your score of 580 anymore, which is a complete lie. But the consumer doesn't know that because they're trusting in this lender instead of the lender just saying, listen, we don't want to do the loan, right? We don't want to do the loan. Our policy is we don't do FHA under 600. They're just trying to push it off on FHA. And then, some of these people may think that they can't buy a house then and go away, where they should know that there's other options out there and they should really shop around and understand that it's not an FHA guideline. Like you said, it's an individual lending institution guideline as far as that minimum credit score goes.
Yeah, you're absolutely right, Brian. And even to take it a step further, FHA has no credit score requirement at all.
Right.
Period. None. The FHA, if you have a job and you live in an apartment where you're paying rent and you've made 12 months payments on your rent and you have rent checks to support it, and you have car insurance and you have a cell phone bill and you've had those three pieces of credit, just as an example, the rental one you have to have, but the other two, a cell phone, car insurance, electric bill, utility bill of some other sort. If you have those three things and you have those pieces of credit have been open for 12 months, you can get a mortgage with just that. And I've done that for lots of people. It's called it's a manual underwrite, and it's an alternate credit loan where there's no score at all. The people don't even have any credit. And so when you hear lenders pushing that agenda where it's FHA's rule, it's really them looking for cover for making a mistake on the loan that they've got. Instead of being honest with the borrower, saying, hey, this is just something that we can't do for you. You're going to need to go and find a lender that doesn't have this overlay that's preventing you from getting a mortgage. Right,
exactly. I think that's hugely important because I hate to hear stories of people who got this, maybe heard that and got discouraged. We're with a lender and they say, oh, no, you can't go FHA because your credit score is only 580. And then they give up and they go sign a year lease somewhere or whatever when they really could have gone ahead and potentially purchased a house if the lender was honest with them. And I hate to say dishonest, but if some of these big box lenders are that way, and it's sad. So that was an important point to cover.
When you get into the nitty gritty on FHA loans, a lot of times the professional that the consumer's dealing with just doesn't know the rule exists, and something obscure pops up, and then they just blame it on FHA. But it's really the lender with an overlay that is causing the issue.
Right.
So
where do we think that I know the Fed came out and has done a couple speeches and public appearances, which is not necessarily normal. What do we think that is going to cause the interest rates to do moving forward?
Well, I mean, interest rates right now are fantastic. I just today I priced out an FHA loan for a friend of mine. It was at 2.875 with a minimal cost, like maybe $800 in lender expenses. Your Fannie Freddie loans are down anywhere at 3.25 to 3.375, depending on down payment and credit score. So rates are fantastic, and I think they're going to get better over the course of the summer. What's interesting about rates right now is that after COVID-19, you have the mortgage industry in general has a lot of risk that's being built into writing deals. The lenders are worried about people losing their jobs. They're worried about people getting laid off and put into forbearance agreements, and they can't make their payments. When somebody stops paying a lender, the lender still has to write checks to Fannie Mae or Freddie Mac or wherever the end loan user is. So all that risk is being priced in the interest rates. What's happening on the other side is the Fed is buying all the paper it can. Meaning, what's that mean is it means they're creating artificial demand for mortgage-backed securities, and they're driving rates down. So those two forces are kind of working against each other right now, and the result of that is the rates that we're seeing on the street, which are really good. I think at some point in the future, when the government gives us the all clear sign, and they say that the coronavirus effects on employment and on people requesting forbearance agreements and that kind of stuff, once they give us like the all clear sign, then the risk that's being priced in by the lenders is going to dissipate. It's going to reduce. It's going to be priced out of the market. But I think the Fed's going to keep driving rates down because they're going to try and get the economy moving back to normal as quickly as possible. And low interest rates is a great tool for the Fed to do that with. So I think over the course of the summer, as more and more restrictions are eased, you might see pricing get even better, which is really, if we can get down into the upper twos on all products, it'd be fantastic.
Hey, Doug, on average, what would you say the the pricing difference between a non-QM product and a FHA product or a conventional product?
I bet you at this point it's probably 2%,
Wow.
maybe more. You know what I mean? I'd be curious to see, especially since it just came back, because the investors that are buying those new non-QM loans, I would imagine they're asking for a pretty hefty premium.
Now, the non-QM loans are less restrictions. They don't care about the quality of the property, septic.
No, I wouldn't say that they're less restrictions. I would say that they're different. Quality of the property is the collateral. I don't think anybody's really going to budge too much on collateral concerns. What non-QM is really for is really geared towards the self-employed people, or the people that have other sources of income that aren't necessarily usable in the world of Fannie and Freddie, and with those other incomes, they can, their bank statements, deposits on their bank statements are larger, and that's what these lenders base the loans on. It's alternate versions of how you create income for yourself, not your traditional pay stubs and tax returns.
Gotcha. Thanks, Doug.
Mm-hmm.
What about the refi market? You're saying you quoted somebody at 2.85. Can I get a 10-year note at like 1.5 now? I mean, what's going on in the refi market?
Nah, the refi market is it's good. I mean, rates are low. The refi market's got some different challenges, especially people trying to do cash out. So that the cash out refis require appraisers to go in the houses, and they're being priced a little differently. In the cash out market, Fannie was not buying any loans that were in forbearance, so lenders were not going to make the loans. And that risk was being passed along to the lenders still doing cash out. That risk was being passed along to them. This is that's out in the world of Fannie Freddie. The big thing with refis is that they're taking a long time. In my world, purchases are always prioritized with the shops that I deal with, and the volume that's currently passing through the mortgage business right now is causing some delays on execution on refinances, on getting them from the point of origination to the table and getting them closed. You just got to.
What are some negative outcomes that have come from the coronavirus that you see not going away anytime soon?
The big one that is it's an overlay. Self-employed borrowers in Fannie and Freddie right now are being, what's the word I'm looking for? They have to go through a more rigorous underwriting process. And this is lender to lender to lender. These are not Fannie Freddie guidelines. These are Home Point or Wells Fargo, or wherever the lender is. And what's occurring is this: self-employed borrowers are always underwritten based on what their tax returns show. So right now, everyone who is self-employed is in 2020, and their income will not be reported or realized until they're 20 for this year, until the 2020 tax returns are due next April. Lenders are wary of what they're currently making. So lenders, what they're doing is they're reducing the income. If you showed $100,000 in income in 2019, the lenders are going to take 75% of that number and use it to qualify for a mortgage today. To offset that reduction in income that they're implementing, they're making you have large reserve requirements. Meaning, so if you have 6 months reserves in the bank or 12 months reserves in the bank, they will not reduce your income. So, and these are a myriad of overlays, because every lender is got their own set. So what works for one lender may not work for another one. So if you're self-employed right now, you may absolutely run into some challenges depending on what lender you're working with and what their overlays are pertaining to specifically to self-employed borrowers.
What about the secondary home market? Are we seeing anything different there? Obviously, we deal a lot in secondary homes in South Jersey. A lot of our viewers would be, interested in that.
The second home market's pretty clean. I haven't seen any new guidance come out on it. I haven't seen any overlays that would affect the ability to obtain second home financing. They haven't upped the down payment requirements. They haven't upped up any reserve requirements. Yeah, that market's pretty stable.
And now, what about investments? Somebody that wants to buy a multifamily building.
Multifamily buildings right now, you can't really use income to qualify on. So if it's going to be an investment property and you don't have a history of showing rental income on your tax returns, you're not going to be allowed to use any of the future rents of the property to qualify for the property. Which for somebody who's trying to get into the investment property game, that could hurt them. if they need that rental income to qualify, they may not be able to obtain that loan.
Right. So to clarify that for some people who may not fully understand or haven't done this before. So what you're saying is that if I was going to buy my first multifamily, I wanted to buy a triplex.
Mm-hmm.
Normally what happens is a lender will take a percentage of the proposed rents that you're going to earn from that property and use them as income for you before you even make the purchase to help you qualify, correct?
Correct.
That's what it used to be, and now they're not doing that.
What Fannie, there's a two-part test to this one. So currently Fannie, they changed their guidelines. Unless you have a history of managing rental properties already on your tax return, they will not use any anticipated rents or future rents on a multifamily or just straight investment property to help you qualify. All right. On top of that, a lot of lenders, some of the investors that I work with all the time, they are considering rental income to be self-employment income. And as such, they have overlays on top of it where they're not allowing you to use it, or they're using it at a reduced amount. And the fear there is how many people aren't paying their rent right now out of the 30 million people that are unemployed. And until this COVID-19 blows over, those types of credit overlays on pertaining to investment properties, I think, are going to stay here for a while.
Gotcha. All right. So it sounds like there's some things are starting to come back and get back to normal. There's some things that aren't, and there's some good that's come out of this. Obviously, like interest rates, potentially some bad, but overall, I know we were very busy over the past weekend, so the real estate market overall is looking to continue to be strong. So it sounds like the mortgage market's going to be hand in hand. Would you agree with that?
I would. I mean, honestly, the biggest challenge I think we're having in the mortgage business right now is it's taking a little longer than normal to get some deals through the pipeline. Especially the lower scored FHA stuff, because there's not as many investors or lenders participating in that market right now. So the biggest thing I would say is if you're buying a house, you should definitely look for a 30 to 45 day close. You can get them done in 30 if it's really clean, but that's the biggest challenge that I'm saying. It's actually.
Doug, QM, are all conventional products QM?
Yes.
Okay. Gotcha. That's interesting about the rental income too. I was hearing something like Crest took it from 75 to 50%. You could use, like, they're decreasing the future or the rents you could take to work for you with your income, debt to income ratio.
Yeah, and Crest has the ability to do whatever they want to do, because don't forget, they're servicing all the paper. They don't have to conform to Fannie Freddie guidelines. They can set that number at any number that they choose. But I'm not surprised by that. It's kind of commonplace in the industry right now.
And you are a broker or a direct?
I'm a broker, so I have the ability to find the right fit for an individual that has some of these challenges, because again, there are some companies that have no overlays at all. And they're getting deluged of business in certain markets because they don't have any overlays. But there may be other drawbacks to that company. With 30 some plus investors that I'm hooked up with, that it gives us the ability to try and find the right fit for somebody who are having issues in these, I hate to say these trying times, but it's the challenges with the mortgage business from COVID-19. Every lender's got some different wrinkles to them at this point.
Yeah, if these interest rates keep dropping, though, man, there could be a refi boom. That'll be good for you guys.
It would be. Just they're going to have to hire a lot of people in the mortgage business. There'll be some jobs out there for people that want to work in it, because they need bodies right now.
Yeah.
Yeah, the major players all are probably looking for help. Yeah, man.
Cool.
So, another interesting thing about all that's occurred is the appraisal process. I mean, we talked about this last time when we were on with Dan last week. Was how the COVID-19 is affecting appraisers and their ability to do reports and the positives and negatives that are arising out of that.
Yeah. Yeah, especially some of that's a challenge for us if they won't come down and look at properties because we just have such a different marketplace down here where they can, they can severely miss the mark by doing a desktop instead of getting down here and doing their actual research for someone that doesn't know, for an appraiser that doesn't know the market specifically.
Yeah, and look, all the government deals, it works in the opposite fashion, because if the appraiser doesn't have to go into the property, they may not discover all kinds of repairs that need to be done.
Right.
That may be good for the borrower, may be bad for the borrower. It depends, But
some of it's going to be like we thought before. It's going to be, stink for some of these agents who like to keep bringing up ticky-tack things every time they go back so they can keep getting that re-inspect fee. But
yeah,
I won't let my bias go too far into that, though. Well, most of them are good. 99% of them are good.
Nah, it's all good.
So,
Yeah.
cool. All right, man.
Appreciate you coming on today.
Cool. Thanks, guys. I appreciate it, man. It's fun.
Yeah, good info. Good info. Again, Doug Miller, Aspire Home Mortgage. Anybody out there looking for a mortgage locally, he's your guy, man. He's all the state of New Jersey. Like I said, with having 30 different investors, there's not a deal that really I've ever taken a dud that he couldn't get done. We've had to move deals from other people that, again, couldn't do it or weren't truthful with the person or weren't educated enough to realize what they were doing. We move them over and we get them done quick and people are in their houses. So it's a good thing. So, Doug, thanks for your knowledge, your expertise. We appreciate it. Once again, Brian Steer, Ben Haberman, Blue Homes Real Estate Group. Thanks for jumping on Blue Homes Live, and we will see everybody on the next one.
Thanks, guys. Take care, man.
Later.